Alright, crypto fam, gather round for a tale as old as time, or at least as old as trading itself. Picture this. You're sitting there staring at your screen, watching those candlesticks dance like they're at a rave. Your portfolio's looking greener than Shrek after a kale smoothie, and you're feeling like the Wolf of Wall Street. If Wall Street was a bunch of memes and dog coins, suddenly, one of your coins starts doing the limbo. How low can it go? Lower than your ex's standards, apparently. And what do? You huddle on tighter than a koala during a eucalyptus shortage? It'll bounce back, you tell yourself, probably while eating ramen for the 5th night in a row. Meanwhile, that other coin you bought as a joke, because who doesn't love a good meme, is mooning harder than a full moon party in Thailand. But oh no, you've got paper hands. You sell faster, because surely it can't go any higher, right? Wrong. Welcome to the oldest trading rule in the book, my friends. It's so old it probably remembers when Bitcoin was just a twinkle in Satoshi's eye. Cut your losses short. Let your profits run. Sounds simple, doesn't it? Like, don't eat yellow snow, simple. But in the wild west of crypto, it's about as easy to follow as a diet during a lockdown. Most people do the exact opposite. They out here holding on to their losing positions like it's the last slice of pizza at 3 a.m. It's not a loss if I don't sell, they say, as their portfolio bleeds redder than a vampire's favorite lipstick. Meanwhile, they're selling their winners faster than you can say pump and dump. All because they're scared the gains might disappear. But here's the TI fam. Markets reward patience with strength, not weakness. It's like going to the gym. You don't get swole by lifting once and calling it quits. You gotta keep pushing, keep hodling the weights. In this case, the same goes for your winning trades. Let them flex. Let them grow. Don't cut them short just because you're scared of heights. On the flip side, those losing trades, they're like that toxic ex who keeps sliding into your DMs. Cut them loose, block their number, and move on. Your portfolio will thank you later. Now, I know what you're thinking. But what if it bounces back right after I sell? Well, what if pigs fly and Elon Musk stops tweeting about Dogecoin? Life's full of what ifs, my friend. The key is to have a strategy and stick to it like glue. Set your stop losses, decide on your take profit levels, and for the love of all that is holy in the cryptoverse, don't FOMO into every pump you see on crypto Twitter. Let's break it down with a little scenario, shall we? Imagine you bought some Elon Moonrocket coin. Yes, I just made that up, but admit it, you'd totally buy it. It's down 20% and you're sweating more than a snowman in summer. Your instinct is screaming, hodl diamond hands, to the moon. But remember our golden rule. Cut those losses, my friend. Sell it, lick your wounds, and live to trade another day. Now, flip the script. You've got some garlic bread coin that's up 300%. Your palms are itchy, you're ready to cash out and buy that Lambo you've been eyeing. But wait, what if ... And hear me out. What if you let it ride? Set a trailing stop loss, maybe take out your initial investment, and let the rest run like Forrest Gump, who knows? You might end up with enough gains to buy the whole Lambo dealership. The thing is, in the crypto market, trends can last longer than your last relationship. By cutting your losses short and letting your profits run, you're essentially riding the wave of market momentum. It's like surfing, but instead of water, you're surfing on a sea of green candles and hopium. But let's keep it real for a second. This isn't just about making mad gains and flexing on Reddit. It's about preserving your capital and growing it over time. Every trade that goes south is an opportunity cost. That money could be working for you in a different, more profitable trade. By holding on to losers, you're not just losing money. You're losing time and potential gains. Now, I can already hear some of you typing furiously in the comments. But what about DCA? What about long-term hodling? And you're not wrong. Those strategies have their place. But even if you're in it for the long haul, there's no harm in taking profits along the way. Think of it as giving your future self a high five. At the end of the day, it all comes down to psychology. We're hardwired to avoid pain and seek pleasure. Selling at a loss. That's pain, baby. Watching a winning trade, keep winning after you've sold. Also pain. But here's the kicker. Successful trading often means doing what feels uncomfortable. It's like eating your vegetables when you were a kid. You didn't want to do it, but look at you now, all grown up and trading crypto like a boss. Next time you're looking at your portfolio, ask yourself, am I holding on to losers out of hope or strategy? Am I taking profits too early because I'm scared? Be honest with yourself. It's harder than trying to explain blockchain to your grandma, but it's necessary. And now, the million-dollar question, or should I say, the one Bitcoin question. Do you struggle more with cutting losses or letting profits run? Drop a comment below, fam. Are you a diamond-handed hodler who needs to learn when to let go? Or are you more paper-handed than an origami convention, selling at the first sign of profit? Let's get a discussion going. After all, we're all in this crazy crypto roller coaster together. Remember, in the wild world of crypto, the only constant is change. So, stick to the oldest rule in the book, keep your memes fresh, and your portfolio fresher. Who knows? Maybe one day we'll all be sipping cocktails on our private islands, laughing about the time we thought 10x gains were impressive. Until then, keep trading, keep learning, and for the love of Satoshi, stop checking your portfolio every 5 minutes. Your sanity and your phone battery will thank you.